Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello and welcome back to Keen on Retirement. I'm your co-host Steve, and I got Bill and Matt with me here today as always. Hey guys, how you doing?
Doing well, Steve. How are you doing this day and age? You doing well? Spring has sprung.
Spring has sprung. The Masters tournament has concluded. I think we're going to start by talking about that here for a moment, and I think it'll lead into our first question that we have from a listener today about inflation. So we're going to have a little fun with the Masters golf tournament and inflation. So Matt, why don't you kick us off here? How does the Masters and inflation, how are you going to connect those two things?
Well, anyone who watches the Masters, what are they famous for? I mean, even you probably know, Steve, you're not much of a golfer, but what do they always talk about on the broadcast? The pimento cheese sandwich.
Well, that's not what I was going to say.
What were you going to say?
Well, two things. One is the green jacket, of course.
Well, there's that, yes.
There's that. And then the second is that I guess historically, they only had like one sponsor, right? They ran very few ads, and they are very particular in their rules. Things like no cell phones.
Yeah.
Can't bring phones in there.
Well, they'll kick you out if they see you with one.
So they're very particular in how they run that tournament.
Hey, there's got to be consequences or else people break the rules. So, but yes, they have pimento cheese sandwiches and they sell them for $1.50, and they're constantly talking about it on the broadcast. I say constantly, but you hear it enough, especially during the lead up to the Masters and of course throughout the weekend.
Say $1.50, Matt? $1.50?
$1.50. Now,
I don't even get much for $1.50 anywhere.
No, you can't. But well, I mean, think about what it is. It's a couple pieces of white bread and some cheese. It's not necessarily a gourmet meal. But I was curious, how long? Have they always sold pimento cheese sandwiches there? Why? How'd this all start? And since the first tournament, 1934. They have sold pimento cheese sandwiches, and they were 30 cents in 1934, which would be the equivalent of $7.50 today. So,
and they're only selling for $1.50 now?
They're selling them for $1.50.
Wow.
Okay, but that was back in the coming out of the Depression. Think about that. Gee.
Yeah. And and I didn't know much about pimento and pimento cheese. What is it? And so
please enlighten us.
It's a combination of it's cheddar cheese, and it's like a combination of white and yellow sharp cheddar cheese that's shredded, and then pimentos are a pepper. It's a chili pepper, but it's not very spicy. It's not very hot like a jalapeno pepper. And they're very abundant in the southern U.S. So that's kind of where that tradition came from. And fun fact, that little, if you ever see a jar of martini olives, that
for
little
sure.
red
they have it in there.
That's inside those olives, that is a pimento.
That's,
So, maybe people, if they haven't had a pimento cheese sandwich, maybe he's had some pimentos before unknowingly.
Well, pimento cheese and just some potato chips is pretty good, actually. It's not probably super healthy for you, but it's a nice summer snack, around the pool or the boat or something.
If you're walking the golf course, enjoying a nice day. Yeah. Well, I also was curious about the winnings. So we had our champion crowned over, at the end of the event. It was Rory McIlroy, and he had won back-to-back, which there's only been, I think, 4 other golfers who have done that, won it in consecutive years.
Can you name those 4?
Gosh, I know Jack Nicklaus was one of them. I think Nick Faldo.
was one of them.
Yeah. I can't. The other two escape me.
Was it Gary Player? Was he one of them?
He may have.
I guess. Well, we have a way to
We can
find
look
out
it
here.
up. That's we don't
see.
have any shortage of information.
Okay.
Well, the reason I know Nicholas was one of them is because I looked up. Okay, well, I think he was the first one, and that was in 1966. Well, his share of the total purse, which back then the total purse, so that's the combination of all the prize money available to all the winners, was $1.7 million. His share, the winner's share, $20,000 in 1966.
My goodness.
Today, the total purse is 21 million, or was 21 million at the most recent tournament. And Rory won $4 million. That was his share of it. And I say my inflation calculator, it's actually the Bureau of Labor Statistics. So the government actually has this calculator. You can put data in there and say, what's the dollar amount, what month and year you want it compared to, and pick different time periods. So in 1966, 20,000 would be, in today's dollars, just north of $200,000. So lots of inflation that we've seen in prize money and in pimentos and cheese sandwiches that maybe you're not paying, but well, if you happen to get a ticket to the Masters, we'll put it that way, you're paying a lot to get in potentially. So
yeah, I wonder what that is.
With we had cheap that sandwich. Yeah. Yeah, interesting. There's other things, because it's like, well, what else kind of has that price stability? Maybe, the Costco hot dog that always pops in my mind, and I think their rotisserie chicken is still $5 or $4.99 still. So those are two things that have been around.
Aren't lottery tickets? Are they like $1 or $2 for a lottery ticket?
Well, that is true. I don't know how much value you get out of purchasing a lottery ticket. It's a piece of paper you throw in the trash.
I had a wise mentor once tell me that the mathematical odds of winning the lottery are the same whether you buy a ticket or not.
Ah, okay.
We know that's untrue, right?
Yeah, we know. I was going to say, I'd argue that I'll take the other side of that bet.
Yeah. I mean, you can round to zero, I guess, but he didn't say that. So,
Tiger Woods.
He was another one.
0102.
Yeah.
Okay. So we've got Nicholas, Faldo, Tiger Woods, Rory. Is that it? Just those four?
That's all that I was able to find.
Oh, okay. So Gary Player was not one of them, I guess.
Okay. Interesting. Well, along those lines, I did some research to see, okay, what other prices have held that long? So I mentioned the Costco items, and I didn't know this, but that has been unchanged since 1985 on the hot dog and soda combo. So
nice.
That's a pretty long time. Arizona iced tea. So they sell those tall cans. You find them mostly in grocery stores and gas stations. It's printed on the can 99 cents, and it's been that way since 1992. And they've come out and said they're going to maintain that as long as the margins allow them to, meaning they're going to continue to lose money until they actually go negative, I guess. Not lose money, but they're decreasing their profits the more the input costs go up. And then,
but what they don't tell you, Matt, is in that can, now it's only got this much iced tea in it.
Yeah.
The rest is air.
The shrinkflation. That's right. They filled it with,
there you go. That's a good
air.
Now we talk about shrinkflation.
Yeah. And then I've seen signs of this. I am not old enough to have experienced it, but there's 5-cent Coca-Cola signs that are vintage signs, I guess, that you can find and see online or maybe in person if you see one. It's Coca-Cola was 5 cents, a bottle, I guess back then it was a bottle, from 1886 to 1959. That's quite a long time for as big of a company as they were throughout that whole process. And part of the history with that was that they had just long-term deals with the bottlers that allowed them to do that. So interesting how prices change, different different factors come into play, and sometimes it's to people's benefit, like we're seeing with if you happen to be a winner of the Masters golf tournament, inflation's been your friend. But if you're purchasing vehicles and cars and mostly any other product these days, things are going up. That's for sure.
Yeah, I just got my email from Google a couple days ago that said that my YouTube Premium subscription is going from $13.99 a month to $15.99 a month. So I think that's about a 15% price increase. Yeah. So it's like, okay, they're raising prices to pay for all of the AI computing needs that they're investing in. And prices just go up.
So they can
you're not going to cancel
emails.
it, are you? You won't
I'm
cancel
not going to cancel it because I would rather pay an extra $2 a month and not get all these ads when I'm watching a video. So, I'm fortunate that it's not going to kill me to pay an extra $2 a month. So, so we sort of touched on it here, just talking about inflation. And I think that's the first question that we've got here from one of our listeners, from Michael. And he's asking, with oil prices surging and inflation heating up again, I'm worried about my purchasing power. What investments actually protect me during inflationary times? So definitely a timely question here with everything that's going on.
Yeah.
Last episode, we talked about inflation too. So it's been on the minds of our listeners these last few, time periods.
Yeah. Well, it's hard not to probably be on your mind when you've got gas prices, staring you in the face. A barrel of oil is up 70% since the beginning of the year. And then you hear about the conflict in Iran and what's going on with that. And it's like, well, is there any end in sight when it comes to oil, specifically? And then we know, well, it's got its footprint, I guess, or fingerprints in so many different areas too, because petroleum or petroleum byproducts are kind of involved in a lot. So how do you offset that? And I like the way at least Michael's thinking about this because of the way he framed the question. What investments protect me during inflationary times? Not just how do I get around it, but just I'm going to invest. So that's a positive. And then I need to invest in a way that actually is going to help me maintain my standard of living at a bare minimum, because we know if prices go up, that's just what happens. And the reason it happens is because, well, what we don't want, especially, and I say we, I mean, the government is a big part of this, but even as consumers, while yes, we'd prefer to pay less, we don't want to be in an environment of deflation where prices are going down, because then what happens from a consumer standpoint is then you're not going to make a purchase if you think, well, in 6 months or a year, it's going to be cheaper. Because if everyone does that, then what happens to earnings? Well, earnings basically go to zero because no one's buying anything because they're all just waiting for prices to go down.
Well, Matt, let me push you on that, because I know people say that, but I'm wondering, like, in real life human behavior, is that what would happen? For example, like if I wanted to buy a car and I thought that, well, maybe 6 months from now, maybe it's 2% cheaper or 1% cheaper. Am I really going to wait 6 months to buy a car on the chance that it might be 1 or 2% cheaper? I mean,
well, it depends on how much it goes down.
Well, but we don't know how much it's going to go down,
about
right?
Just big screen TVs and technology, that stuff, the way that's.
But are the prices really less? I mean, if you want to go buy a new TV, it's still $1,000. It's just you get more for it.
That's right.
Which is where that inflation metric is so weird, because it's like you can't compare to what we had in the past to today on some things because it's different. But to your point, Steve.
Same thing with because I know people say that about deflation, and we don't really have enough examples of actual deflation happening to know how it's going to change consumer behavior. So I think some of that might be theoretical, but your point is well taken about how the government really wants some inflation to actually happen, and they basically have policies that to some extent they know are going to cause inflation, and they're okay with that.
Yeah, well, and you can see by their actions. And I think maybe the Great Depression was a period of deflation that is probably the only period that we could point to, that at least of recent times, that had definitely a big impact, but there was a lot of other things going in there as well.
Yeah.
So the government, I think maybe there's just some lessons they've learned that's been transitioned over decades that have said, hey, we don't want to go through that again. So we always, even if we don't necessarily know exactly what's going to happen, we don't even want to test what could happen if we were to go through a period like that. Because, the other aspect of it too, I mean, we're talking about purchasing like new goods, like a car or laptop computers or TVs. But think about it from a real estate standpoint too. I mean, if prices are going down, which we do have that from time to time within real estate, it also prevents people from moving and doing things because they anchor to this higher price. So they're not going to sell. They're not a corporation selling. They're just a person who could make a choice to sell. And that definitely has impacts there too, where if markets are moving in the correct direction and people are all rational, they make what's in their choices in their best interest. But since people aren't rational at all times, you get these kind of price discrepancies built in there. But we're talking about inflation and how to invest, and I think we've discussed this in the past. We've had definitely some periods of inflation, high inflation over the past 5-6 years since we went through the situation with COVID, and we were faced with a shutdown kind of economy and hard to import goods and things like that, and prices skyrocketed over a period of time. I mean, I say skyrocket, it's all relative, just kind of compared to where we've been recently. And we're still experiencing it, just at a slower scale. You're seeing it more in other areas. Insurance premiums are going up. I mean, that's been I think, eye-opening to a lot of people. You see what your homeowner's insurance costs, automobile insurance, what those costs are. But then on the flip side, you've got at least people out there. I think Elon Musk has been out there publicly kind of stating this because he's, of course, promoting his business Tesla, and he thinks everything's going to be autonomous, that, well, you won't even have auto insurance at a certain point, because why would you need it if all the cars are robots and they do everything perfectly? Well, yet to be seen on some of those things. But what do you invest in to offset that or to maintain your purchasing power? And I mean, first and foremost, stocks.
Right.
Invest in, businesses that have the ability to raise their prices. That's really the concept behind it, because it's like, well, why invest in stocks or businesses? And it's because, well, they have pricing power too. They pass those higher input costs onto the consumers, and then the consumers pay them, and hopefully the wages go up too to offset that, so people aren't just getting higher costs, but not the offsetting increase in the wages. So right there. And then we have history to back that up. I think we look at long-term averages a lot, long-term average of inflation measured by CPI, Consumer Price Index, which is what the government uses to measure inflation. I think we can go back 100 plus years, and it's right around 3%. On long-term data related to inflation. Stocks, you have long-term averages close to 10%. So right there, you can just look at the history, and of course, there's periods where stocks do go down, and they don't just go up every single day or month or year. But the long run, the advances, it's been permanent. We haven't ever went to zero and never come back from that. So,
and
two, you have businesses that increase dividends too. So, I mean, you have that as part of it as well.
Exactly.
Yeah. Real estate's another one. I mean, yes, you're going to have periods like right now. I would say where real estate, while we're in an inflationary time, real estate has gone up a lot since COVID, using that as a recent time frame. Now, maybe over the last couple of years, real estate's cooled off and in some markets, gone down some, but that's also tied to higher rates, which is more of I would say, a shorter term phenomenon. Now, maybe we're going to have higher for longer interest rates. We'll see, since inflation doesn't seem to be cooling off significantly. Most recent data, long-term inflation was coming in, or at least, annualized inflation was coming in at just over 3%, 3.3, I think was the figure that came out, which then in turn kind of supports the Fed's decision to maintain interest rates, or I don't think they're talking about raising them, but definitely less discussion of lowering interest rates when inflation is higher. But you also have, on the flip side, if you rent out real estate, so whether that's to individuals, so you have homes, condos, you're just renting to a resident, or you have commercial properties, you can increase your rent to offset some of those higher costs maybe associated with maintaining your real estate. So yeah, maybe the values aren't necessarily rising or falling as much depending on the inflation environment we're in, but you can have increasing rents associated with that, which can offset some of it as well. You can also invest in commodities. So you can invest in oil. You can go buy oil's futures contracts. Word of caution with that. If you've never done that before, you definitely probably don't want to just go out and figure out how to do it. You want to really educate yourself if you're truly curious about it. But there are ways to do it within, just a basket of futures. There's things called there's these ETFs that are probably more structured like ETNs, exchange traded notes, which are very, very similar, just, little slight difference there, that can invest in broad baskets of commodities. But, you have kind of weird nuances with commodities. So again, I always encourage people to, talk to a professional on some of these if you're looking to invest in it, because you don't want to get in a situation where you bought something on this futures exchange and they're calling you up asking you where you want your 1,000 barrels of oil delivered. Can you imagine having to explain that one to the neighbors?
Probably close that contract out.
Where are we going to store this stuff? They're not leaving it in the truck, I can tell you that. Now those are owning physical assets. Stocks, well, I mean, a business is a, physical presence typically and usually, but real estate, physical commodities are physical assets. But then you can still have a hedge, inflation hedge, by loaning money to, to businesses, governments, what have you, with specific structures. Because if you just leave money in, money market, well, that's not going to adjust necessarily with inflation, but it's going to adjust based on interest rates. And those can actually, that may not be a good thing to own in an inflationary environment. But then the government has a couple of different ways that you can purchase bonds from the government that do have inflation protection built in. So one of them is called TIPS, or Treasury Inflation Protected Securities. So those are bonds that you buy from the government. So you're loaning money to the government. They're paying you a small rate of interest associated with that. But then also the principal is adjusted with CPI. So they offset, hey, if inflation's going up, they'll increase the principal payment to you. And there's a floor, so it's not going to go negative on you. So they do have a floor on those. But that's a way to get some protection without, if you didn't want to own stocks or you're not quite sure what you wanted to do and wanted to be, I would say, on the very, very conservative side, there's a place to at least get some inflation protection. There's also I bonds or inflation bonds, which, gosh, I remember, I think we were talking about that in 2022, because those seem to have been getting a lot of discussion. And I believe the reason was because like inflation data had come out and it was starting on it, coming down, but you could still get these I bonds at a decent rate of interest because they don't reset. They reset like every 6 months, and it was
That's
still
right.
like this little window. Now, there's a limit. You could still only invest $10,000 into those I bonds. So there's a caveat. It's not like you could put significant sums of money, and maybe with a couple of different account structures, you can get a little bit more invested in those. But those you buy directly from the Treasury, treasurydirect.gov, and there's minimum hold periods and penalties if you don't meet those. So got to be aware of those structures. And then lastly, you can invest money to corporations via floating rate bonds, and those have adjustable payments to you as the loaner of the money based on interest rates. So those have some built-in inflation protection. Now, however, those types of bonds tend to be, I want to say, higher risk because high quality businesses, very stable, highly rated businesses from a financial standpoint, typically aren't loaning money with these types of floating rate bonds. Like they'll loan money directly, to consumers via their corporate bonds at very similar rates that the Treasury and the government has out there. But if it's harder for you to attract investors that way because maybe your business just isn't as stable, I mean, not necessarily a risk of it just going away, but there's just more questions. That's where these floating rate notes come into play. So there's something to be aware of. It's not just because it adjusts with inflation doesn't mean there's not without its own set of risks associated with that.
That's right. And, tips, they're kind of confusing for folks to understand, typically done a little bit better than your nominal treasuries and the like Bloomberg aggregate index by a little, right? Maybe 0.5% or 1% during inflationary times. Although in 2022, the tips actually got hit. They didn't work like folks thought they were, really due to like the surge in rising interest rates, which hurt their prices. So look, when you're explaining these different, you explained the ownership side, whether it's a stock or a physical asset like real estate and others, and then you just explained the loanership side. And you had some good examples. I mean, you did have tips, you had I bonds, you had floating rate notes where rates go higher if rates move in the market. There's different, of course, companies have different ratings. There's really strong companies, and then there's what they call companies that are not so strong, I guess. I was going to say junk bonds, but that is a rating.
I mean, that's a term. It just sounds terrible.
Sounds bad. Of course, those are higher rates. But if you really look at the inflation hedge, which is what I think he's asking, stocks will take the cake every time over any long-term period, whether it's the actual price appreciation of the stocks over time, as long as you're diversified appropriately, or the dividends themselves. Remember, there's two ways to make money when you own a stock or an equity or own a company. One is you buy it and the price goes up and you get a price appreciation. The other is a lot of stocks and companies pay dividends while you wait. Mm-hmm. So every quarter you get a dividend, nice dividend coming in. So the dividends themselves on the broad market have also gone up faster than the rate of inflation. So if you were fortunate enough to have a portfolio that you could live on the dividends, so you weren't taking out principal, you were just living on the dividends, that would have outpaced inflation handily over the last 10, 20, 30, 40, 50 years. So I think that really is what our listener, our questioner was asking. I think that's his answer. And it's interesting too, in inflationary times, people that own assets find their total net worth go much higher than folks that don't. And we call it the K-shaped economy today, right? I mean, that's what we're speaking a lot about, that just by organically, people that have done well, saved, invested, benefit from these things. And that nearly half of America maybe that are not fortunate enough to be able to invest for themselves don't get the benefit of those assets and prices appreciating.
Mm-hmm.
Yeah, and I'm glad you mentioned the tips and being a loaner as opposed to an owner. I mean, I personally have owned tips for many years, and I'm underwater on my investment in tips because
Not
of the
through
change in
Keen.
interest
Please
rates.
be
Not through Keen. No, through my
yes, thank you.
own bad decisions.
We don't want,
Right.
No, not through Keen, but yeah, in my personal portfolio, I've owned tips for a long time, and I'm actually the investment is less than what I actually invested. So even though it's
not net
bumping
of
up
inflation,
because
net of inflation, right?
no, I'm talking just
The principal.
I put in 100,000, I've got
Yeah.
like 96,000 today. The total
Really?
value of it. Oh yeah, it's shocking. It's like, how did this happen?
Okay, maybe
and
we take that off our list today. Should we edit that portion out of our segment? No, I'm teasing.
Yeah. It's like,
Yeah, interesting.
I've been disappointed in owning tips for many years, and
And part of that is because there is an interest rate component too. So it's
yes, and that was the point I wanted to make, is that if you get in when interest rates are low and then interest rates rise significantly, your principal is going to go down, because as interest rates go up, the principal value of your bond goes down.
So you've been receiving interest along the way, right?
Yeah, but I'm saying even reinvesting,
when you factor that in,
even factoring that in, my value's down, which is just it's hard to fathom. But my other point is that stuff like that can get really complicated, and if you look into the intricacies of how that particular security actually works, it gets really complicated, because there's multiple variables that if this happens, then that affects this variable. But if this other thing happens, that variable is actually a positive, not a negative. And it's like there's a lot of different moving parts, and it's just hard to tell when is it actually going to be a good investment.
Yeah.
And I'm not trying to say that tips are a bad thing. It's just, if you're thinking about investing in tips, make sure you really read the fine print. You work with someone like you guys to really understand what are the actual mechanics of how this thing works. When's a good entry point for something like that? What type of environment is it most conducive for that particular investment to actually be successful?
Yeah. And this is all in the context of a diversified portfolio. So it's like, we talk about things individual, and it's like, well, none of them are a solution for all your money. They're all pieces of the puzzle. And they have different weights at different times, but it's all pieces of the puzzle.
Yep. All right. So this, I think it's a nice segue to the second question here. So here we're talking about inflation. Now we're going to talk about taxes. Two favorite topics, right?
That's right.
So Susan's question here is, she says, I got a raise this year, and I'm worried that I've been bumped into a higher tax bracket. Does that mean all my income is now taxed at this higher rate? So another good question, something that might confuse some people.
Most people, I remember back when I got, Matt, I mean, you said earlier you're not old enough, but I mean, come on now. You're gaining on us, mister. You used to say that when we first started.
I can never catch up.
You used to say that when we first started when he was 19 or 20, right? But now he's in his mid-40s, Steve. I mean, come on.
But 44, anyway. Less than mid-40s.
You could be my son, Matt.
I love it. Well, but so when I got in the industry before Matt, 24, 30, I'm 34 years in my 35th year, I think. So
you couldn't be my son, Bill.
I couldn't?
No.
Okay. Well, okay. I was going to say that makes me sad, Steve, because there's times that you've been a great mentor to me over the years. But hey, we'll just leave it at that. Yeah, sure. Oh, for sure. So people did think, though, back there was a time where I don't want to make another dollar because it's going to push me into a higher tax bracket.
Yep.
And that never was the case, that you wanted to not make that extra dollar. Now, rates were very different. There was a time where rates were higher, of course, but you never wanted to not make the extra dollar. It didn't hurt you on the other dollars behind that dollar. So anyway, I'll let you explain it, Matt.
I mean, that's, in there. Where this gets complicated and confusing is there are components to the tax code that are basically a cliff. $1 over it triggers this, surcharge, I like to say, just to keep the terminology kind of different, because we deal with this a lot when we're doing our tax planning, is Medicare surcharges. So you have a standard premium that you pay unless your income is from 2 years prior over a certain dollar amount. And then it's a cliff, $1 over triggers this additional surcharge for your Medicare premium. And there's kind of other things in the tax code that are like that. But what we're talking about is your federal tax. So what you pay just to the government from your income. And, some of that's earned income, W-2, self-employment, or IRA distributions, if they're, from a tax deferred type of account, or, if you have an insurance type product that has deferred income as part of it, all that is taxed as ordinary income. And one of the concepts I think it's important to understand is like the marginal rate and the effective rate. So the marginal rate, when we talk about all the tax rates, there's 7 different tax brackets at the federal level. It starts as low as 10% and goes up to 37%. And there's, a range of income in there, and it's different whether you're single, married filing jointly, married filing separately. There's, a handful of different filing options. But the marginal rate, that's the bracket your next dollar of income is taxed at. Not, like as Bill mentioned, not your previous income. It's just your next dollar. So by moving $1 over into this higher bracket, it's just that $1 that's taxed at that higher rate, not everything else. The effective rate, that's where we look at, well, how much tax did you actually pay divided into your taxable income?
Would you say the average rate? Just what is your what is your average tax rate?
You don't usually get aware of that.
Now, Matt, did you say by your top line income or by your
You could do it either way. More common is with your taxable income, but you could do it either way.
Yeah, but people want to know, hey, if I made $150,000 and my salary.
Yeah, what's your just gross income?
Once you run it all the way through the brackets and you get your deductions and you get through these various things you just shared, what did it end up being from the top line?
Exactly.
Pre-deductions. And then that gives you an idea, like a apples to apples comparison.
Yeah, here's an example. So let's talk about a single filer. And, you think about this you may be married, but if you're working, like, okay, if you were to file as a single, or just what's my paycheck, or what's my my salary, because that's for a lot of people, that's their gross income, their salary,
Yes.
And if you're married and you're both spouses are working, then you combine that for your tax filing. But for just this individual example, and the current 2026 tax bracket, so I mentioned there's 7 of them. The 10% bracket is on the first $12,400 of taxable income. So right off the top of everyone's paycheck is the standard deduction. And that's the amount of money the government allows you to receive tax-free right off the top.
Yep.
And for a single filer in 2026, that's $16,100. For a married filer, that's $32,200. And if you have certain expenses, such as state and local taxes, charitable donations, there's medical expenses over a certain threshold, and mortgage interest, those are the most common deductions. If those all add up to be more than the standard, then you would claim an itemized deduction, which means you get even more money tax-free, is really what that means. Now, you're spending $1 to save whatever rate you're in, your effective rate, but you're at least getting a benefit for spending those dollars from a federal tax standpoint. And a lot of the states kind of follow along with that. But, we're talking just federal here. So I mentioned the very first bracket, 10% on the first $12,400, double it if you're married. The next bracket, so that's from $12,401 to $50,400. And that's the 12% bracket. So only income in that range is taxed at 12%. And then we'll just go up one more bracket. So The next bracket, the 22% bracket, from $15,401 to $105,700. So those are the first three brackets. And again, you could basically just double those for a married filer, in the tax code. So you take right off the top. So let's just say your gross income was $90,750. So just our simple, we'll do a simple little tax calculation here. You don't itemize. You just take the standard. So 16,100 comes right off the top. So what's left, 74,650, that's what flows through to those brackets that I just mentioned at the federal level. So you've got that first 12,400. So that's taxed at 10%. And then you've got from 12,401 to 50,400. That's roughly $38,000. That's taxed at 12%. And then it's just the portion up to that 105,000 I mentioned earlier that's taxed at 22. Well, this person, they're at 74,650. So it's 74,650 minus 50,400. 24,250 is taxed at 22%. So we add all of those up, 11,135, and that is your total Fed liability. And if we divide that into your gross income, so that 90,750, you paid effectively 12.3% federal tax on all your income.
That's what we're talking
average.
About. Right there. So somebody thinks they're in the 22% bracket and they paid 12. Well, like you said, the first portion is zero because of the deductions.
Yeah,
a lot of it's 0%. So it's really not as bad as folks think, especially in retirement when FICA goes away and some of that. So
yeah. So I mean that's to answer Susan's question. We would never tell someone to turn down a raise because it's going to push you into a higher tax bracket. Even though you're going to pay more potentially tax on that specific piece of the raise that's in a higher bracket. It's still your net ahead at the end of the day. You still have more tax, after tax dollars than if you would had you not taken the raise.
Except
which is good. It makes sense. We don't want to have a tax system to where it's going to incent people. Well, I don't want the money because it's going to trigger all these additional taxes.
Yeah, but except for, you kind of corrected me up there. I was saying there was never a time ever that you would never want more. And then you instantly discredited me a little if somebody was paying attention because you said, well, wait, there's this cliff thing on the Medicare surcharges.
That's right. I know.
Which kind of I was right, but you were. There's this other.
Well, it's not federal tax.
That's correct. So I was right on the Fed tax, right? But when you said that, there is reasons not to, but it's not that.
Yeah,
it's not the one. Yeah,
and the Medicare, and you still. I mean, again, if you look at what the surcharge is relative to what the raise would be, probably still better off. But again, that's true. A individual calculation that we can help people with. I mean, we help people with it all the time, and it's because. I mentioned that surcharge. There's all these different components. I mean, Social Security's taxed differently. There's a different formula for Social Security. You got the Medicare surcharges and everything else. You've got net investment tax. That's a different calculation and a different rate that you pay on investment income. Then you've got capital gains that are taxed at different rates and qualified dividends. So it's like, well, how do you put all these pieces together?
You talk to a Keen Wealth advisor, and we run mock tax returns for us, our clients,
and we
work with your CPAs.
Exactly. I mean, we go through the tax return with all the components built in, and we can see exactly if we do this, this is the impact that it has on all these other scenarios. Because you'd have to be a tax professional to figure this out yourself, and even then, it's complicated because there's a lot of things in the tax code. As simple as they say they're making the tax code, it's never getting simple. I'll put it that way.
That's right. Hey, I had a success story. I know we're probably going to wrap here in a moment, but I had a success story. I had someone do their taxes and bring it in for me to review. And yes, I know we have somewhere close to 20 credentialed advisors here or on the path to their credentials that help us, but I can still do these things, Matt, Steve, personally. Good. Okay. So I was reviewing the tax return, and she is a single lady, and she made about $65,000 last year. We had advised her to live off her retirement account and maximize Social Security, and she had a great job in her career. Yeah. So her Social Security is like over 50,000 because she waited till 70, and she had a pension of about 15 from her job, so about 65,000 of top line income coming in. And when she ran it through, the system and looked at all the deductions, things you just explained, and how a lot of Social Security isn't taxable for someone that has a lot of their Social Security coming from Social Security, she had zero tax. And then the 6,000 that came in, the over 65, the one that existed, and then the new 6,000 that came through, it was zero tax. And she had withheld no taxes from Social Security or pension, but didn't owe any. So she actually did exactly, and we had advised her to do that, by the way.
That's great.
She didn't need to withhold anything because there was going to be no tax. So that was really interesting to see. You laid out a case where someone made 90,000 and paid 10 or 11%. In this case, this nice lady made 65,000 and had zero tax.
Zero tax.
Interesting, isn't it? Yeah.
Yeah,
good
very
place
much
to
so.
be.
Yeah. And it's interesting, all the nuances to the tax code and how many of them are designed to drive specific behavior.
Yes.
Or driven by certain special interests that have a lot of influence. And
what are you talking? People are biased?
Never happened in my lifetime. But yeah, that's why I think one reason why the tax code can be so wonky is because there's just so many different incentives that are in there to try and drive various types of behavior.
Yeah.
And I don't think that, at various times over the decades, there's been pushes to try to simplify the tax code, but every once in a while, something will get a little simplified, but overall, it seems like it just continues to expand and expand and expand.
Yeah. Yeah. I mean, they come and go where with the Tax Cuts and Jobs Act, which was passed in 2017, one thing that they did was increase the standard deduction, fairly significantly, which means
that was a big move.
The hurdle to itemize got higher. So that's where some of those incentives live, because it's like, well, if we're going to spend money on this, you have to spend enough to actually get a tax benefit. And if you weren't, then depending on what it was, you may not make that purchase or do that thing. And so that simplifies things for people when that happens. Now, but it's like, well, you're getting a good portion of your income tax free because that hurdle's higher too. So it's not necessarily, it wasn't worse necessarily for people. It just made their lives easier from a tax filing standpoint.
Yeah,
that's right.
Yeah, actually, that's a good point there, Matt. When they raised the standard deduction, that reduced dramatically the number of people that could, had enough deductions to file their taxes to itemize their deductions. But now, of course, we now added the state and local tax. From capping that at 10,000 to what is it now, 40,000. A lot more people are going to be eligible to itemize their deductions again. So that's sort of reversing it, but it was a tax break. So it's like people are going to do that. Give me a little more complication if I can save some money on my taxes, I suppose.
It's like, we kind of, we need to clean this up, and then enough, like you said, special interest or enough complaining. Okay, we got to do something now and give something back, and it starts to then go the other direction.
Right.
I think a stat I saw, the Tax Foundation said, based on the one big beautiful bill that was passed last year, they said it was about 10% of people itemized, I believe, in 2024. And then they expected that to increase to 12% based on those new provisions that you just mentioned, Steve, that were passed as part of that. So it's not.
That's a
20% increase.
That's 20% though, right?
Yeah,
of the 10%.
It's definitely so interesting. Yeah.
That's all right. Well, great. Well, we should probably wrap it there. And speaking of taxes, by the time people listen to this, we'll have passed the tax filing deadline April 15th. So hopefully everybody's got their returns in and you're getting your big tax refunds.
Or at least your extension filed.
Or your extension filed. That's right. Yeah, great. All right. Well, Bill and Matt, as always, thank you. And for each of you listening, thank you for being a listener on the show. And please tell all your friends and colleagues about what we're doing here. We'd love to continue to expand the number of folks that are listening to this. And you can also watch this on the YouTube channel. And we've got how many thousands of subscribers now to the YouTube channel? I think
we're just under 10,000. Yeah.
Yeah. Knocking on that door. Yeah.
Oh, my goodness. So I would encourage each of you listening, if you have not subscribed to the YouTube channel, please do that so that we can get over the 10,000 subscriber mark, which is a huge number. There's not a lot of channels out there relative to all the channels that are on YouTube that actually have that many subscribers. So we're very appreciative of each and every one of you that are participating in that. So, and if you have any questions or comments, please check us out at keenwealthadvisors.com. And we'd love to get some of your questions answered here on the show. And again, thank you, all of you. And we'll catch you on the next episode of Keen on Retirement.
All right. Thanks, Matt. Thanks, Steve. Thanks, everybody.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.